Hi, I'm Tom Askell, and I'm the author of The Complete Guide to Investing During Retirement. And what I want to talk about today is fear. Fear of the stock market. Given the recent downturn in the market, it's a rather timely subject. A lot of my friends have come up to me and said, "Wow, your book just comes out and now the market crashes. Who's going to want to buy your book? Who's going to want to invest in the market?" Well, the truth of the matter is, this is the best time to invest in the market. And what I want to do today is show you why I would say that. And to understand that, we'll have to go back to the great stock market crash in 1929. And what we're going to do is we're going to use that crash to understand the market. Because the best antidote to fear is knowledge and understanding. And that's what my book attempts to do. It attempts to give you the knowledge and the understanding to overcome your fear. So let's take a look at that 1929 crash.
This is a stock chart for the Dow Jones Industrial Average from 1900 to 2004. The Dow is a sampling of 30 stocks, which are taken from the various stock exchanges, and they represent a cross-section of the entire economy. For any given period of time, they are plotted on the chart as a single point. Thus we have a chart that looks like the one presented, where the Dow is rising from 1900 all the way up until 2004. Now the rise is not perfectly linear. As you can see, there are a lot of wiggles and waggles in the chart. However, if you plot trend lines through these wiggles and waggles, it's clear to see the upward trend of the chart. This is especially true from the Second World War on, where the trend has been roughly 8% compounded interest per year in the price of the Dow. Add to that an additional 2% in dividends, you can see where they get this statistic that the market will deliver 10% per year over the long term. Given this demonstrated long-term performance, why are so many people afraid of the stock market? One answer to the question are the wiggles and waggles. But to get to the real answer to the question, we have to look down into the area of 1929, where the market supposedly crashed. Now the crash occurred in October of 29, when the market had reached 391, its high, and fell to 41, its low, an 89% decline. But the first thing that you'll notice about this fall is that it took over 2 years to occur, which meant stockholders had plenty of time to get their money out of the market. This ability to get your money out of the market is called liquidity. And while liquidity is an important observation within this chart, and is dealt with in more detail in my book, the real observation we want to make isn't liquidity. It's twofold. First is that the stock market crash wasn't really a crash. And second is that investors who were in the market at the time of the crash were not really hurt if they chose to stay in the market through the crash. To understand these two critical points, let's take a closer look at that 1929 area of the chart. Let's analyze this concept of a crash. When we use the term crash, we tend to think of something traveling along a given path and then bumping into some type of an obstacle, which causes it to either stop or fall or in some way be negatively impacted. Now when we look at the chart here, which is a close-up of the 1929 crash, we can see that that's not really what happened. The market was traveling along, but then it took off. It rose from its channel, which was between around 50 and 100, and quadrupled in price in about 5 years. Then at 391, it simply tumbled back down into its original trading range. That's not a crash, that's a bubble. What the stock market did in 1929 was break its own bubble. Thus we have answered our first question. The crash of 1929 was not a crash. It was a bubble. How does this affect an investor's thinking? Well, look closely at the chart. If you were saving during the crash by placing your money into the Dow, you can see by the black line that throughout the whole affair, from 1900 all the way through 1935, you would have lost nothing. You may not have gained, depending on when and how you saved, but you would have lost nothing. If you look at the 3% growth line, and you had invested prudently in the early part of the 1900s, you might have actually come out of this supposed crash with a 3% annual growth rate, plus dividends. So by 1950, you would be very close to having a 5% compounded annual growth rate in your Dow-oriented investment. Your return on investment would have been considerably higher than what you would have gotten in the bank at a time when many banks were failing and people were getting nothing. There is no reason to be afraid of the stock market. Even the great boogeyman, the 1929 crash, turns out to be toothless. Did you notice something else in this chart? If you were out of the market throughout the 1920s and had cash in hand, there was a great opportunity here. When the bubble burst and the market fell from 391 to 41, within 1 year of that low, the Dow was back up to 100, over a 100% gain. And by 1937, the Dow was up to 194, almost a 500% gain. If you had money to invest after the bubble burst, it was a great opportunity. So to the question, is this recent downturn in the market an economic crisis or an opportunity? With the help of my book, you will be able to answer that question for yourself. And equally important, you will develop the confidence to take advantage of those opportunities and use them to secure your financial future, no matter how big or small your nest egg might be.
So as you can see from our analysis, if you were a long-term investor in the stock market at the time that it crashed in 1929, all you had to do was stay in. If you were making prudent investments in a series of stocks that mirrored the Dow, then your basic investment would have been safe. You would have not lost any of your savings and probably would have gained as much as 5% per year all the way through the Great Depression. And if you were a person who had been afraid of the market, then you had a great opportunity after the crash to step into the market in the depths of its downturn, which would have given your retirement nest egg a very significant boost, as we have seen as much as 500% in as little as 5 years. Now that's the kind of opportunity that we're looking at today. If you haven't been in the market, now's the time to consider getting into the market. And my book will help you gain the knowledge and understanding to step into the market in an intelligent and informed way. That knowledge and intelligence will give you the confidence that you need to make prudent and successful and winning investments in this market or any other stock market.
The title of the book is The Complete Guide to Investing During Retirement, and is published by Adams Media, and it should be in your bookstores no later than December of this year, 2008, just in time for Christmas. It would make a great gift for an older parent, a grandparent, or even for yourself if you have been thinking about getting into the stock market but have been afraid to take the plunge. So look for it now at your local bookstore, or go online to Amazon.com, Barnes & Noble, or Borders, where you can pre-order it. Or if you want further information about the book, its content and its goals, visit my website at retireestocks.com. I thank you for your attention, and here's hoping that fear never comes between you and financial security.